The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. Here are your headlines today. The sell-off accelerates. Japan's Nikkei 225 plunges into bear market territory, while South Korean stocks track towards their worst session since the pandemic. The Nasdaq enters correction territory with its worst three-week run since September 2022, after weaker than expected non-farm payroll print, while futures point to another rough session on Wall Street.
Warren Buffett's Berkshire Hathaway dumps almost half of its Apple stock, boosting the conglomerate's cash fortress to a record $277 billion. And Israel braces for potential retaliatory strikes from Iran following the assassinations of two militant leaders amid fresh fears of an all-out regional conflict.
Good morning, everyone. We certainly moved a long way when it comes to the market trades. And at this stage, I think you've got a lot of market participants saying, are we setting up for a recession? And the big broker notes that have gone out from Goldman Sachs to JP Morgan are just putting into the horizon prospect the possibility of a downturn. So they're saying Goldman Sachs 12-month recession odds now lifted by 10 basis points to 25%. This is in a note. JP Morgan even more bearish now at 50% probability they see for a US recession. And this on the back of a payrolls report. And you've got to wonder whether this is a market that is moving too aggressively around the payrolls report. Are they overreacting to what could also be a report that gets corrected the next month? Will there be some revisions? But I think the fascinating point is the hedging that will go on in this session today.
You know how they say that one swallow doesn't make a summer?
Yes.
I wonder if this is not a similar case, but in the other direction, right? To say you've had all this strengthening data or this resilient data out of the US economy as well, right? And it's really looked like that economy can continue, and recession fears were almost wiped out by a lot of analysts. And then some said, yeah, we fear that the Fed has gone too far and perhaps could have started cutting in July. They decided not to, and perhaps if this data had come through before the meeting, maybe they would have decided, actually, let us cut now. So my question then becomes, how far behind the curve do they feel now? Or is it just a case of, it's one piece of data? Let's wait for the rest.
I mean, let me just contextualize this. For a long time, we've been talking about this market that was late cycle, that, was last person out, turn the lights off. Yeah. And then, a few weeks ago, I had a conversation with someone. They were saying, look, we're mid-cycle. Yeah. This is a cycle that can be extended. And suddenly, we're right at the end of the party. Yeah. And someone is pretty much very close to turning the music and the lights off. So just where are we at in this cycle? It's going to be very, very fascinating for the debate, I think, over the course of the morning.
Something we're definitely going to talk about throughout the show as well then.
But meantime, a lot of moving pieces across in those Asian markets today. We are seeing Asian equities under fresh selling pressure. Japanese stocks have sunk into bear market territory, while South Korean equities are on track for their worst session in 4.5 years. Let's get out to Lynn then. She joins us with a closer look at the action in Japan. Lynn, how are things looking today?
They're not looking good at all, Karen. We're seeing, as you've just highlighted there, the Nikkei 225 and the topics around those bear market territory off the back of the falls we saw on Friday as well, and volatility absolutely spiking at the moment. The Nikkei volatility index is up around 95%. And then we've also just seen moments ago that the futures, the Nikkei 225 futures trade has been suspended off the back of this panic selling and the intense volatility that we are seeing. In terms of the sector breakdown, we're seeing financial stocks, banks, they are getting hit hard again. So the top three banks in Japan, for example, they have fallen all by more than 15% for the day off the back of double-digit falls on Friday as well. We spoke with Richard Kay from Comgest earlier today. His view is that when you look at how these stocks were going before this sell-off, they were all up more than 40% off the back of this exuberance around banks, around insurers, because of monetary policy normalization. But he says when you look at the fundamentals of these banks, there hasn't been much improvement, so there could be more falls to come. And then when we look at the other areas here, tech has been getting hit hard. All of the heavyweights, you've got Toyota down close to 12%. SoftBank Group is down 15%. Tokyo Electron 15% as well. And then when you look at the broader picture, if you look at the JGBs, they are continuing to get bid. You've got the 10-year yield now falling by around 15% and now at 0.808. You've got the 2-year also falling as well, now at 0.071% as well. So that really reflects the sentiment here. It is very, very gloomy. If you look at all of the sectors, they're all falling. But the best performing, I suppose you could say, is those defensive areas like utilities as well as healthcare. In terms of what is driving this price action, we've spoken to a number of analysts, certainly a multitude of factors coalescing together, but the big one, of course, is the yen appreciation. We've seen since early July, it's appreciated by more than 10%, and that is accelerating today. Dollar yen at the moment sitting at 143.20. Of course, we know so many of the big stocks that we follow on the Nikkei 225, they are all net exporters. So there's an inverse relationship there. And then, of course, the big carry trade unwinding here in terms of this forced selling. This was the favored trade, right? The yen carry trade. And now we are seeing, as the yen is accelerating, as we're seeing, of course, the Fed picture, the likelihood of more cuts. That's at least what the market is pricing in, plus the more hawkish pivot here from the BOJ and the expectation of that interest rate differential compressing, all of that coalescing together for now, guys.
Lynn, thank you very much for the roundup. But I mean, who thought monetary policy moves would have no impact on Japan? And you've got to think about all those fund managers that were suggesting they still like Japanese equities as a trade this year. To me, if you look at the curve that you've seen on the Nikkei 225, there's been no exit point. If you had been invested in that market this year, the extent and the speed of the sell-off has made it very difficult to get out. It's been a one-way direction. And just to compare and contrast to the S&P 500, that is quite a different curve to what we've seen to the US market. This is a different equation.
It really is. And I mean, I'm just trying to crunch out as many of the numbers as I possibly can. Like you said, year to date, right, it's down 1% already. The most prodigious part of the sell-off really has been this month. Up until the end of last month, you had actually seen at least a 6,000 point gain. Off the highs, yes, but you had still seen a significant gain to 39,101. That's fallen now 10.45% just this month already.
Everything wiped out from this year, all in a short space of time. Let's move on to the rest of Asia, though, and see what else is moving. South Korean equities are also under fire. Sherry has more for us. Sherry.
Yeah, let's kick off with the breaking news, the latest for the KOSPI. So that is the tech-heavy junior index in South Korea, facing this trading halt. So this is the circuit breaker, and it will go on for 20 minutes, given the over 8% moves to the downside that we saw. And of course, something similar was, of course, applied to for the KOSPI, the benchmark index in South Korea as well, which is now down 7.7%. So which is having the worst session since March of 2020. And the sidecar, the circuit breaker for the KOSPI, was triggered for the first time in 2020 as well. In this major dump in equities, there is no discrimination in terms of sectors, but there are some noticeable worst performing sectors, and they are South Korea's shipbuilders. This is a sector that has been really enjoying all these green transition, and of course a lot of European clients actually having to buy new vessels in order to, and of course the adoption or more demand for LNG ships, but the sub-index is now down more than 12%. And of course we've got the chips definitely out of favor and facing yet another dismal session as well. And we're talking about more than 30% of losses from all-time highs that was just seen in the month of July, just last month for SK Hynix as well, which is down 9%. And we've got the Samsung Electronics also sitting lower at the moment by more than 9% as well. However, we've got bonds rallying and rallying hard. And we're talking about, of course, the effect of rate cut bets shooting higher. The market was already pricing in 2 cuts for the BOK in this cycle, but now that's being dialed up. So we've got the most liquid, the 3-year sitting at 2.84%, the 10-year at 2.9% as well. So if you're looking for any green, it's really the inverse ETFs or some of the exchange traded notes that are tracking volatility or government bonds. But other than that, it's really hard to find any kind of trade and anything safe on the board at the moment in South Korea on this Monday. Guys, it's back to you.
Yeah, Sherry, thank you so much for that then. Really an interesting picture, and we're going to really unpack it as well throughout the show as well and get into the weeds of it a little bit more. But really, a lot of this also happened stateside, and was this data that kind of triggered a few fears and worries then from investors. U.S. non-farm payrolls coming in well below expectations, totaling just 114,000 then for the month of July. Now, the unemployment rate rose to 4.3%. That's the highest level since October 2021. The jobs print is adding to fears of a broader economic slowdown, with markets ramping up rate cut expectations. In fact, the Fed is now expected to cut by 50 basis points in September. Just September alone, with the target rate seen in the 400 to 425 basis point range or lower come the end of the year. We'll be hearing then from the heart of the Federal Reserve this morning. Our U.S. colleagues will be speaking exclusively to Chicago Fed President Austin Goolsbee. That's happening at 2:30 CET. Very quick look at the U.S. futures then as we head towards that market a little bit later on. Of course, having seen the sell-off that we saw then on Friday, some of the market even reaching some correction territory there as well and beyond. U.S. futures looking red. More sell-off anticipated then as we started that market trade. Of course, a few more earnings prints as well to anticipate out of this market. A big hit as well seen out of the Russell 2000. So those small cap stocks not necessarily faring as well as some have thought thus far then, with recessionary fears in play in this market. Overall, this is what the U.S. market looked like then as well on Friday. This was the trading day then. Of course, Wall Street falling sharply. It was because of those worse than expected jobs numbers that we saw then for the month of July. The data igniting those worries and fears about a recession possibly. And more prodigious rate cuts then coming out of the Fed, possibly a more than 2% tick down for the Nasdaq composite, then the S&P 500 as well, 1.8% weaker. A lot of those tech stocks also getting hit then. Correction territory for the Nasdaq, as I'd been pointing out. For the week as well then, 5.7% the S&P 500, Dow 3.9% below their all-time highs respectively. Third consecutive week of declines then for those last two, as I made note of. I spoke about those tech stocks being a key reason as well for this drawdown that we have seen. And there's the picture then for you. While Apple as well as Meta were able to gain, especially Meta there, 4.82%, the clear outstanding one there. Intel, a massive loss of nearly 32%, 31.5% there. That's its worst day in around 50 years. So a significant drawdown overall there. Onto your treasuries picture here, sinking to fresh lows ultimately, even this morning then for U.S. treasuries. Traders anticipating aggressive Fed rate cuts from here then. Recession fears seeing the 10-year drop 5 basis points even. It's near 1 year low there, following on from the 40 basis point plunge just last week. That was the steepest drop since March 2020.
Let's get into this market sell-off with Cole Smead, who is CEO Smead Capital Management. Cole, there's no doubt there's been exuberance in some technology stocks this year. Now we have a report card from the non-farm payrolls, and it suggests that, look, we are seeing a slight cooling off in that labour market. Is it enough to suggest a recession? Some analysis of the data says, look, we've had a significant increase in the number of people on temporary layoff that has risen by close to 250,000 in the month. This could suggest there's a correction coming down the track. What do you make of the market reaction we're seeing now?
Yeah, I think you very much have to detach the economy from what's going on in, obviously, the markets. These markets did not climb on some exuberant excitement about the economy, and now that's being pulled back. These markets climbed on euphoria and a mania, I would argue. So the real shocker, economically speaking, is that we can't find a recession yet. And I say that because I'll use Goldman as an example. I think they changed their recession number from 15 to 25%. So there's this idea that at some point we're going to have a recession, and that always happens. The question is what causes it, and if what's going on overnight looks like as bad as it's going to be in the end, we will likely have a recession that's led by the loss in asset values from the fall off in the stock market. Think of like a 2000 to 2003, where the euphoric parts of the stock market ended up being the ugliest parts of the economy 2 to 3 years later. And therefore what it did is it drew in large unemployment in those kind of areas. And so that's back when places like San Francisco were ghost towns for jobs, back in times like 01, 02. So we don't look at this as a tie to the economy. If anything, there's conversation over the weekend how the Fed might not trust their own models. The reason why is because if you raise 500 basis points on short-term rates and you can't cause a recession, what model are you using?
We've also had a Fed here that's been so fixated on consumer price inflation, not asset price inflation. So what does the Fed do now? Because we've got a lot of market participants saying we could see a 50 basis point move in September lower. So what does the Fed do in this context?
Yeah, the Fed is trying to fight a ghost in some respects. The ghost is a massive amount of federal spending on deficit, 7% of U.S. GDP, and it's very hard to counteract a problem like that you didn't create. So the Fed has tried as much as they can. I think Jay Powell is doing all he can to try to understand that problem and counteract it with monetary policy, but it's a fiscal problem, and that fiscal problem is not ending. Let me add one more thing. Let's just theorize that Iran does go to war with Israel. I was born in 1983. In my lifetime, peace has been a common thing. And peace looks like it's leaving the stage left right now. And war is always inflationary. So to your point, Karen, at least in the interim, the CPI numbers have tamed and cooled. At the same time, though, has the fiscal spending gone away? No, that's a big problem for the Fed. And secondly, any war pressures globally become another problem for the Fed. I mean, let's just say oil woke up at $90 a barrel. The Fed has, now flies in the ointment, and how are they going to deal with that pushing on prices in a way that, they can't counteract oil prices? That's not their job.
Cole, you straight into the area of fiscal spending here. And the reality is we've had so much government spending to date, almost borderline heading towards wartime spending before there's been a major conflict to try and prepare for the West. I mean, there have been a number of conflicts elsewhere, but when it comes to spending for Western governments, we've already ramped up the amount that has been thrown at the system. What is the ability for fiscal stimulus to step in this time to counteract what could be a recession?
Well, I don't think the recession's our biggest problem in America. I think watching stocks drop 40 and 50% in some cases is not dissimilar to what the meme stuff did or what the IPO market did back in, off the fall off of 2021. So, if you look at the labor market, to your point, you're seeing some of the statistics show up, but you're not seeing a big drop off in employment. I mean, at roughly 4%, we're still at a historically low unemployment rate. You'd have to see that pick up quite a bit to have it cause problems after the economy. We're still growing. We still continue to grow in an elongated way. I really think the fiscal problem could be as interest costs rise, that becomes a bigger spend rate, up there with Social Security, Medicare, and Medicaid in the United States context. But then the other question is defense spending is having to pick up. And so if you go into a world where the United States and the West is not leading in these global conflicts, and they are not leading, don't kid yourself for 1 second, what would it cost them financially to have to finally step in a more real way? And to quote Winston Churchill, he once said that the United States always does the right thing after exhausting every other avenue. And these conflicts, I would argue, we're just exhausting the avenues. We're waiting till something finally drives us into a real conflict, but we're not going to do it anytime before then.
Yeah, you know, Cole, the most interesting thing was that as the rate cuts went higher and higher and higher, one of the question marks was what would break first? Is one going to say now that the jobs market is the one that broke?
Yeah.
I mean, 114,000 is still fairly significant historically. It may not be the 175 that the market was looking for, and 4.3% is not very far off still from that 4% average. And you have then growth that they're looking for at 2%, still the inflation picture long term still looking like 2%. Should there be any panic here?
Yeah, well, I mean, to your point, we're in the middle of a political cycle. So, is it likely that, is it likely to see us tame our fiscal spending in the interim? The answer is no. Not only will the political cycle not argue it, but whoever comes in as president, whether it be Kamala Harris or Donald Trump, there's going to be an interest in trying to prop up anything. So I don't think the job market will necessarily tell you, because again, that has been, I think, abnormally helped by that fiscal spending. So that part of it, I think watching the job numbers has been the tough part, because it's continued labor market strength. And I'll add one more part of that. If you go back and look at the data since the pandemic began, what you'll find is that the lowest income groups in America have benefited the most on a real wage basis. It's not white collar. It's not the high income quartiles. It is the lowest income quartile that has absolutely done the best. Now, what can you take that away to be? Well, we're short people. We're short people to work low income jobs, and those are starting jobs in many companies. We don't have enough people. So why are we fine collecting a bunch of people across our borders? Because we need laborers. We need people to do work at a starting point and then grow their careers. And that's just not happening. And by the way, that's not unique to the United States, but I just pointed out because that's what really shows up in the labor market. We have too many white collar people, I would argue. At some level, if AI is right, we're going to have too many coders, because the one thing I've learned is AI can do a lot that a college-educated coder can do.
Yeah, Cole, just very quickly on another one here as well. Berkshire cutting their stake then in Apple pretty much. I mean, how significant is that then to what we think of Apple? They've planted AI into their systems now significantly. So they're hoping for this upward cycle in upgrades, or upgrade cycle, should I say as well. Should we be looking at the company slightly differently now?
Yeah, his sale of Apple reminds me of him fixing his errors of the past. The old saying is, fool me once, shame on you, fool me twice, shame on me. In 1998, Buffett called Coke and Gillette, which is now part of Kraft, he called them the inevitables. And he said it's just inevitable that in this ubiquitous product category they're in, that they're going to succeed. Now, by the way, he was right in that they were inevitable to succeed in their categories. The problem is when he could confidently say that, he should have been selling the stocks. And he later came back in future meetings at Berkshire and said that he should have been doing so. He cooed about Apple, and I think the issue with that is that's a big problem for Buffett now.
Cole, thank you so much for joining us. Great to have your thoughts on a big market event day like this. Cole Smead, CEO of Smead Capital Management. And just to recap for you, in case you missed the story, Berkshire Hathaway sold off more than $75 billion in stock during the last quarter, including nearly half of its stake in Apple. Berkshire's cash pile rose to a record $277 billion. Berkshire has also started paring back its stake in Bank of America and trimmed its holdings in Chevron. However, it held on to its long-term holdings in Coca-Cola and American Express. For a full breakdown of Berkshire Hathaway's big rotation out of equities into cash, you can head online to CNBC.com.
Now, coming up on the show, the sell-off continues, and that's in Asia, but the moves aren't nearly as big in China. We'll go through the latest data out of the world's second largest economy after the break. Plus, earnings season does continue. I think that it has slowed down, with Infineon numbers due in the next few minutes. We'll break it down with Aneta later this hour. And don't miss our conversation then with Energy Aspects founder Amrita Sen, as oil prices plunge almost 5% in the first few days of August. That's coming up at 8:30 CET.
ambition to me is about doing better.
I think ambition creates a pathway.
Best advice I can give to someone starting off a career is don't have a career, have lots of careers, try loads of different things.
Talk to people and put your ambition out there.
I don't feel that I've hit peak ambition because it's a learning journey.
CNBC is where ambition meets opportunity. What does living ambitiously mean to you? Hear it from our CNBC anchors, reporters, and global business leaders on CNBC.com.
And let's move from that market sell-off to the economics here. And China's services activity expanded in July for the 19th straight month, with the Caixin Services PMI rising to 52.1, despite overseas demand easing to its slowest pace in 11 months. And let's get out to Sam for more. Sam, we're battling concerns this morning around the prospect of the US recession. I mean, it's still early doors here, but we've got a lot of broker reports we're wading through. In that context, how is China looking?
Well, no doubt, Karen, very good morning to you. The US slowdown would not bode well for some of those exports, which really, as the data is suggesting, is the only thing going for China at the moment, given the domestic demand still looks sluggish. However, we did get that encouraging print on the Caixin Services PMI today, 52.1. That is comfortably above the boom or bust line, and perhaps the markets need some good news on the services side, particularly because they are trying to boost consumption and services. They even came out with a 20-point action plan over the weekend to try to do that. I'll address that in a second. But what we need to do with this data is contextualize it, because if you look at the year-to-date levels, it is still above, or I should say under average, below average 52.1. So new orders looked solid, and that was behind the headline number, why managed to come off the 8-month low, but still the new orders, when you look at the year to date, aren't looking that strong overall. There were some bright spots in this data, particularly on the jobs front. That looks encouraging because we know that the services sector makes up for a big chunk of the Chinese economy, about 60%, and it is a big generator of jobs because this survey does look at the SMEs. So that was good because it actually ticked up at the highest in nearly a year. But then you still had some concerning trends in this data. One of those was a softening in the overseas demand, actually at 11-month low. And then you had some of the input prices, which also weighed on sentiment as well. The business confidence gauge, this has been one that we've been watching for the last couple of months. It's still at these sort of 4-year lows. That brings us back to the onset of COVID-19. So that's just the sort of sense of how these companies that are being surveyed are feeling right now. It doesn't look like it's improving that much. So to answer your question, Karen, that's probably the sort of impact that this US slowdown and sort of some of the concerns around growth is having on some of these companies as to how they're feeling about the economy right now. And so the next thing to watch, because of course this does give us some good forward-looking indicators, is the trade data out on Thursday. That's the big one, to see how much of an effect the US slowdown might have on some of those outbound shipments. And then we'll get the inflation on Friday for an idea of how the economy has been holding up.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.